I'd like to welcome you to the New York Alternative Investment Roundtable event for April 2023, entitled Improving Commercial Real Estate Investing with Fractionalization. I'm Robert Akeson of the Riverside Management Group, the moderator. Today, we are very pleased to welcome Will Powers of AKRU. Will is Chief Operating Officer and Head of Capital Markets for AKRU. Will has more than 30 years of experience in the financial services industry, roughly 2/3 of which has been spent raising capital for alternative investments. Prior to joining AKRU, he was CEO of Alternative Advisors, a consulting firm for real estate sponsors looking to raise capital through independent dealers and RIA channels. And before that, he helped launch multiple successful sponsors and products, including Dividend Capital, Preferred Apartments, and ING funds. I think you'll find Will's perspective to be very interesting and leading edge, and potentially quite useful regarding real estate investing, especially in our current market and economic conditions. Before we meet Will, though, I'd like to thank our sponsors for their ongoing support of the roundtable and this call in particular. And up on the screen, you can see the names. They, of course, include Alston and Bird, Baker Tilly, Bloomberg, Deloitte, Grant Thornton, New Mountain Capital, Ultimus Leverpoint, and our nonprofit sponsors, Kaya, the United Kingdom Department of Trade, Fordham University Gabelli School of Business, and the Grand Duchy of Luxembourg Trade and Investment Office. And just a reminder to our audience, Will's going to be answering my questions for approximately 45 to 50 minutes, and then we'll open it up to the audience for any questions. However, as is our practice, at any time during Will's presentation and comments, we encourage and invite the audience to send questions into the panel. You can send them to either Britt, BJ, or myself using the buttons at the bottom of the Zoom page. So let's get to it. Will, again, welcome. Thank you for joining us today.
Thanks for having me.
You know, I think it'd be good for you to start by telling the audience a little bit about AKRU from a high-level standpoint. What can you tell us, Will?
Sure. Well, AKRU is a platform that fractionalizes or tokenizes commercial real estate using blockchain technology. The company was founded by my colleague and CEO, Mohsen Masood, and really the background of the company started as just a real estate management group for their family office. And they had some challenges where they had a large liquidity request from some of their investors. And as most real estate funds have the challenge of doing, is trying to, create liquidity in basically an illiquid asset class.
Yes.
So, they did a road show, got introduced to blockchain, realized how this technology can be revolutionary for the real estate marketplace. And that's really was the aha moment. And that's where the foundation of AKRU became.
Yes, very interesting. And before I follow up on that whole issue of the blockchain and tokenization and whatnot, I'd like you, given your perch in the industry, so to speak, what does the current real estate investing landscape for RIAs and other investors look like? What's your view on that?
Yeah, I mean, up until this point, it's been a challenge for RIAs to really embrace investing in some of these real estate products. I mean, typically the structures that have been out there have been non-traded REITs, Reg D private placements, Reg A's have evolved more recently. In those types of scenarios, the challenge is there's really no liquidity. It's a long hold period, typically 5, 7 to 10 years. And, although they state that there's a quarterly redemption opportunity, it's tough to facilitate those. So up until recently, RIAs have had a challenge of how do they invest their clients' money in these programs that are relatively illiquid. And as a fiduciary, how do they justify charging a management fee on something they're really not managing?
Yes, and in your opening comments, you mentioned tokenization and fractionalization. What exactly are they, and how does that apply to real estate investing, particularly real estate investing as practiced by a crew or facilitated by a crew, I should say?
Yeah, the process of tokenization or fractionalization is basically we're digitizing the equity stack. And we have the ability using blockchain technology to break down the equity stack into $1,000 shares. These are called tokens. It's very much like an IPO for a company, but it's an IPO for a piece of real estate. So we're able to simplify the process, break the equity down into $1,000 shares, and then we have a secondary trading platform that allows investors slash financial advisors to go in and buy and sell the tokens. The tokens very simply represent a digital LP interest in the asset. So the token holders are going to benefit from their share of the net operating income derived on a quarterly basis. They're going to receive a K1, so they're going to receive depreciation pass-through and tax sheltering of that income. And then also the value of the tokens are directly correlated to the value of the asset. So as that asset appreciates over time, the value of the token should appreciate as well.
Okay, and so does this mean that the underlying investor, the LP, does the LP have, is the LP known to the issuer?
Yeah. I mean, the issuer has access to the list of LPs and owners of those tokens. That's facilitated all through our platform. But at the end of the day, the interaction between the investor and the asset owner or sponsor is really, done on our platform. So distributions and K1s are done on the platform. Any updates provided by the asset owner are filtered through the platform. And the platform makes it a lot easier to manage a larger investor base for the asset owner. And there's a lot more transparency for the investor and the RIA by running through our platform as well.
So it sounds like this is quite an advance in terms of how LP investing is done to this point, particularly LP investing in the real estate space. What is the underlying technology that's being used here to facilitate this process?
Yeah, so like I said, we're using blockchain technology. I think the biggest misnomer that I have to overcome is that we have absolutely nothing to do with crypto. Crypto is actually a use case for blockchain technology, but blockchain is really it's a distributor of record. It's an immutable ledger. It makes transactions more efficient and transparent. But at the end of the day, we have nothing to do with crypto. This is not a DeFi product. The tokens are actually collateralized and attached to a real asset, as opposed to crypto that really is a bit of guesswork as far as how that works. So this is really and it's considered a security. So we follow the rules of the SEC and FINRA. So we're very much on board with this being a security, whether it be very transparent and just utilizing the blockchain technology to help move forward, the real estate investment marketplace.
Sure. And so given what you just said, how does real estate tokenization benefit an asset owner?
Yeah, so if you look at an asset owner right now and he's got a portfolio of various, call it multifamily properties. Typically, they have loan to values in the 60 to 65%. So if they own several properties, they have a good chunk of equity sitting in these assets. But the only way to create liquidity right now for them is really twofold. Number one is they can sell the asset in its entirety, and now that asset is out of their portfolio. They don't receive any management or property management fees, and they have to redeploy the asset. Or number two is they can do a recap and basically refinance the asset and pull some cash that way. What tokenization allows them to do is what we call create partial liquidity. And what that does is they can basically take that equity and sell a portion of it, but they still maintain ownership of the asset. They still maintain management and control of the asset. It's within their portfolio, but it now gives them the ability to redeploy some of the equity in their current portfolio for a variety of different reasons. They could pull cash for themselves. They could create liquidity for their LPs. They could use that cash for improvements on that asset or other assets. They could use that equity to fund a development deal or to purchase another asset. But the key is, especially in this current, credit market environment, going to the banks is still a bit of a challenge. So it's probably a cheaper source of capital. They get to redeploy it and put it to work, and it's already within their portfolio. So it creates a whole nother level of liquidity for them without losing that asset.
Sure. And it also sounds, and correct me if I'm wrong here, but it sounds like it makes it easier for investors to own real estate.
Yeah,
And hold it.
I mean, in those types of products I talked about earlier, if you go into a Reg D deal, the typical minimum is $25,000 to $50,000. If you have $1 million to invest and you want to allocate 5% to a real estate portfolio, with those types of minimums and barriers, it's going to be a challenge for you to properly diversify. So here,
Yes.
instead of getting into 1 or 2 deals, with the minimums being $1,000, you can take that same $50,000 investment and technically invest in 50 different properties.
Yes.
Obviously, we don't recommend that because that's a lot to follow. But an RIA can set up a model portfolio where they can set up 8 to 10 different properties. They can pick the geographic location. They can pick the risk profile, the income profile. They can pick the property type and manage that portfolio. And all the while, if they need to rebalance or reallocate or create liquidity, they can sell those tokens at any point. They don't have to go to the sponsor and request a redemption. They control their destiny on the liquidity side.
Very interesting. Very interesting. And why don't you walk us through an example? How would it actually work?
Yeah, sure. So let's say we've got a $20 million asset, a multifamily somewhere in the Southeast. Let's call it 50% loan to value just to keep the math straight. So there's $10 million worth of equity in that asset. The asset owner has an interest in potentially tokenizing, creating some liquidity on the equity stack. So what we do at AKRU is we'll do an initial due diligence. We'll take a look at that asset. We'll gather some information from them to come up with an approximate value of what we feel it'll list for on the platform. The key component to that, though, is when you look at real estate, there's a bit of a discount to marketability because it's an illiquid asset. And when we're taking a relatively illiquid asset and we're bringing it to a relatively liquid state, we're actually reversing that discount to marketability and we're creating a liquidity premium. What that simply means is on the equity stack, the asset owner will realize a 10% premium. So that $20 million building with $10 million worth of equity would list for $21 million. So there's some value to the GP and the LP right out of the gate for tokenization. From there, we'll go through a full due diligence as if we were buying the asset ourselves. Because it is a security, we do, have a responsibility to check and balance the information that's provided to us from the asset owner. And then really the tokenization process, we'll develop a virtual roadshow. We'll do a webinar. We've already taken the data and put it into a data room that is attached to the blockchain. And then at that point, once we're ready to tokenize, we go live and we set up each of these offerings as a minimum and a maximum. So on that $20 million building, let's say the max that they want to raise is $2 million. The minimum for it to be worth it for them is $1 million. So it's very much like an escrow. We'll take indications of interest and that money will be put into, an escrow type of scenario. Once that $1 million is hit, the money is released, the tokens are minted, the cash is moved over to the asset owner, the tokens are moved over to the investors' wallets or the RIA's wallets. And then we continue to finish out that raise for the next 90 to 120 days. From that point, there's a 90-day cooling off period. And then after that, those tokens are available to be traded on the secondary market.
Interesting. And so why is this a better way to invest in real estate? Let's say then, as opposed to, let's say, a mutual fund or a direct investment.
I mean, even if you look at publicly traded REITs, their underlying portfolio is brick and mortar, but they're publicly traded. So therefore they have a 70 to close to 80% correlation to the S&P 500. The purpose to
Okay.
invest in real estate is to have a non-correlated asset class, right? To create diversification so you're not moving when the market moves. So when you invest in a publicly traded REIT or an ETF that's investing in publicly traded REITs, you've lost that non-correlation aspect. Number two, as I mentioned, the barriers to entry. You know, the typical investment deals can be $25, $50, $200,000 minimums. This, you know, with $1,000 minimum allows for more access, lower barriers to entry, an easier way to diversify. And then really it's the liquidity aspect that by us having a secondary trading platform and allowing folks to sell their tokens whenever they want at whatever price they want, it now enhances the ability for them to make these allocations knowing they're not locked up for a longer period of time. But and then the other aspect compared to REITs is whether it be a non-traded REIT, a Reg D offering, or even a publicly traded REIT, there's a lot of fees involved. There's acquisition and disposition fees, there's management fees. So, you know, typically with a non-traded REIT or a Reg D offering, you may be getting 89, 90, 91 cents in the ground. So you're diluted by 10%. Whereas 100% of the money is going in the ground with our tokens. So you don't have all of those underlying fees that are diluting your return. So you're getting a direct investment, a non-correlating asset, lower fees, lower minimums with liquidity.
So how does the return profile compare, let's say, from a tokenized asset, a fractionalized tokenized asset, the way you're doing it versus a mutual fund, let's say?
Yeah, I think our return profile is really directly correlated to the submarket that the asset is in. So, you know, if you look at, you know, a submarket of Atlanta, multifamily, what are they trading at? What is the cash on cash return? So it's a direct correlation to other real estate assets. So, you know, what we're seeing right now, multifamilies are trading, you know, or cash on cash somewhere between 4.5% to 5.5%. Industrial deals are kind of in the mid to low sixes. We've seen some self-storage with coupons between 6% and 7%. Hospitality is doing very well. We've seen kind of in the high 6% to 7%. You know, the one area on the commercial real estate side that we're a bit hesitant on is obviously office. I think from a real estate perspective with the whole COVID scenario, that still has to play itself out. And are people going back to work 100% of the time, or are they more, you know, working from home, or a hybrid of that? So, you know, the office market, I think, has got some bumps ahead of it, but the other sectors in asset classes, you know, kind of, again, that type of asset in that specific subsector with its competing properties, that's really going to define the type of cash on cash returns that investors will realize.
And Will, what do you think the profile of an appropriate investor for this product looks like? What type of investor should be doing this, or would be appropriate for this approach to real estate investing?
Sure. Well, right now we're only working with accredited investors because these are set up as Reg D 506Cs.
Yes.
The intent down the road is to open it up to retail investors either through a Reg A offering or a registered offering, and we expect to see that happen sometime in the first half of next year. So we're working with accredited investors. But, you know, if you look at, you know, the typical institutional profile for investing, which does trickle down to financial planners and ultimately investors, those folks invest upwards of 30 to 40% in real estate. I think a lot of financial advisors would recommend at least a beginning allocation of perhaps 10 to 15% in real estate and alternatives. Some are a little higher than that, some are a little bit more conservative. But adding real estate to a portfolio enhances income, it enhances diversification. So I think anyone who's an accredited investor is a great candidate for this type of investment. And again, with the minimums only be $1,000, if they want to start with, you know, $10,000 and diversify into a couple of different properties, this allows them to do that versus the other types of investments is very prohibitive and it's not an option for them.
Yes. No, it's very, very, very interesting and in fact, quite leading edge. Are you tokenizing at the asset level or the fund level? How does that all work?
Yeah, so currently we're tokenizing at the asset level. So what that basically means is each token will have a specific property that it is connected to. My expectation is that we will start tokenizing at the fund level in very short term. Franklin Templeton has a U.S. government securities fund that's got about $260 million in it. And that is the first fully tokenized fund that is out there. And again, when you're tokenizing at the fund level, the difference is, we've seen in the press recently that the non-traded REITs have to close their quarterly redemption windows. BlackRock has, they had, call it, 50 million in one quarter, and they could only provide $25 million worth of liquidity. So by tokenizing at the fund level, it now eliminates those share redemption requests that investors have to get in line for. Instead of them having to go back to the sponsor and hoping the sponsor has cash available for them to cash out, they can just basically take their tokens and list it on the secondary exchange. So although we're tokenizing at the asset level right now, things are moving forward. You've got the CEO of BlackRock talking about they want to tokenize all of their equity at some point. Again, Franklin Templeton is already in the game. A lot of the major real estate players are starting to evolve and work into tokenization. So I think you'll see a combination down the road where you can buy tokens into a specific asset, or you can buy tokens into a specific fund.
And so to get a little more pointed with this, how can wealth managers, how can RIAs and other market participants, professional market participants, take advantage of tokenization and fractionalization in your view?
Yeah, well, our platform was designed specifically to help RIAs find a better way to invest in real estate and help them invest into fractionalized or tokenized real estate. With that said, we developed an RIA portal. And so an RIA can basically sign up for that portal. They can download all their clients' basic information. They can do trades in a block trade scenario where it's an omnibus account, or they can do it in a managed account scenario. They can monitor all of the tokens that they own. They can see the buy and sells that they have. So we're trying to making it as easy for them as possible. But the second benefit for the RIA portal is we give RIAs an exclusivity to new offerings that we have coming on the platform. So if you're signed up as an RIA onto our platform, you get a free look for the first 30 days. The public does not get access to those. So, the intent would possibly be that those deals will sell out prior to that 30-day window, whereas an RIA can now go to their client and say, listen, I only have access to this versus, you don't have access for 30 days. This is how I'm bringing value, to this relationship.
Okay, very, very interesting. And so, Will, we have a question coming in from the audience here. Does this process mirror the historical trend from physical securities to book entry?
Well, I think it eliminates the book entry side of it. And that's the beauty of the blockchain, is it digitizes the whole process. There are no wet signatures involved. There are no subdocs involved. So if you look at the old school, book entry, it can be monotonous. It can be time consuming. There can be human errors. That's why blockchain, I feel, is really revolutionizing real estate, because it's going to eliminate all of those issues. Transactions are done in seconds, not weeks or months. You're eliminating the cost of intermediaries. You're eliminating the risk of human error in some of these transactions. So I think this is finally bringing real estate to a higher level of technology and moving it forward, where it's been so antiquated for so many decades.
And of course, I think you indicated earlier, Will, this technology facilitates the asset being titled in the name of the investor, the beneficial owner, as opposed to an intermediary. It's not in street name.
Correct. Yeah. So we basically take the asset, we drop it into an SPV, and then we tokenize that SPV. And so to oversimplify the process for us, the Schedule A represents ownership in that asset. What we're basically doing is just digitizing that Schedule A and tracking who owns those tokens. And if one is sold to another person, we're able to track that immediately. There's no book entry involved. There's no paperwork. There's no title that could potentially be mishandled. So all of that is simplified and made a lot more efficient and effective.
Yes. And what would you say the challenges to this type of investing are currently? How come we don't see this? Why isn't this more widespread, or is it?
It's growing over time. I think number one, it's education. Real estate owners, operators, and developers are old school, where they're dealing with spreadsheets and PDFs. So educating them and making them more aware of the benefits is moving the ball forward for them to tokenize more of their assets. There's no standardization yet. There's a few tokenization players out there, and we are, to my knowledge, the only tokenization firm that does it from A to Z with a secondary trading platform that only does real estate. There are other tokenization companies that will tokenize art and
Yes.
rare coins and cars and whatnot. We're specifically made for real estate. But to get back to your question, the biggest uplift for me is education. Whether I'm working with an asset owner and talking to them about how to take advantage of this, or I'm working with an RIA. RIAs are very cerebral and they want to do their diligence and they need to understand this before they move into it.
Yes.
So I spend most of my time educating folks, either one-on-one or presenting at conferences or forums like this. I think the biggest next move in this space is probably already happened, where you've had a major player either start tokenize their assets or tokenizing their funds. And with Franklin Templeton starting to tokenize their funds, I think you've got a lot of major players kind of standing around the pool waiting for somebody to go in. Like we all know those summer parties. We've already got players in the pool, so now the ball is moving forward. People are becoming more educated. It's more top of mind, and I think in the next 12-24 months, it's going to be a completely different world than what it is today and what it was 12 months ago.
And so what impact do you think it'll have on prices?
Well, it's interesting with real estate, pricing hard assets is always lagging, at least a quarter, right? If not longer than that, because typically asset owners, they don't want to do evaluation of their pricing and appraisals more than once a year. So with blockchain technology and some of our technology partners, we're able to provide pricing and valuation technically up to the minute. So you're not lagging by a quarter or two, you're not lagging by 12 months. You know exactly what the value of that property is versus other properties in that space in real time in the moment. And obviously, I can see some real estate asset owners have a challenge with that, especially in a downward sliding marketplace, whereas you're starting to see a correction in some asset classes, and perhaps they want that information to lag a little bit. They don't want to report bad earnings or bad numbers.
Sure.
But I think it also promotes much more transparency. So if you have real-time pricing, you have real-time trading, much like the stock market, you have full transparency on what's going on. And I think that's much better for really everyone involved, especially in the real estate side, where there's a lack of transparency in a lot of those transactions.
And so you just made an interesting point. You drew a parallel between what you're doing, I think, and let's say the role played by a exchange in the public markets. So in the public markets, companies go to exchanges and seek to be listed. Okay, that's usually how it works, I believe. How does it work here? Do owners of real estate come to you? Do you seek out the owners of real estate? Which comes first, the chicken or the egg here?
When it comes to the asset owners, it's a little bit of both. I can tell you, I joined AKRU a year and a half ago, and really, for our first year, what we wanted to do is focus on educating asset owners and building a pipeline of high quality real estate that we could bring onto the platform. And I'll never forget the first conference I did. It was an IMN conference in Georgia 2 Novembers ago. And I did a 15-minute presentation on tokenization. It was mainly multifamily asset owners. Nobody had any idea what I was talking about. And this is a year and a half ago. Their heads were spinning, their eyes were rolling in the back of their heads. I could see the looks on their face, like, they're on their phone and all of a sudden they start looking up. They have no idea what I'm talking about. I had a few people come up and talk to me after. I did the same conference in California a year later. And not only did I have questions and people understood what I was talking about, but we had a line of asset owners saying we wanted to start tokenizing. So the point of that story is, in a year, we went from complete unawareness to general awareness. And I think that's an exponential trend that we're seeing going
Yes.
forward. So we do have some asset owners seeking us out. And, we obviously reach out to them to try to make them aware of what we're doing and educate them and hopefully get them comfortable with the process and the opportunity.
Yes. And let me ask you a follow-up question on that. What about corporate governance? Are there any corporate governance issues here? I know you drew the parallel to exchanges. These are securities, but they're not publicly traded in that sense. They're LPs. Are there any corporate governance provisions here? Do the LPs have any seat at the table when it comes to corporate governance, or not?
Yeah, I think that's part of the role that AKRU plays in this process. We require updates from the asset owners on a quarterly basis. We look at these 100% as they are securities, so we set them up as Reg D 506Cs. We have an affiliation with a broker dealer. We have an affiliation with an ATS. So we're well within the fairway of SEC guidelines and FINRA rules. But also,
so AKRU plays the role, in a sense, similar to the role played by an exchange, which is to say, it ensures that the issuer meets certain requirements, call them listing requirements.
Yeah, correct. I mean, we're doing initial due diligence. We're running appraisals. We're pulling third-party reports. We're verifying all of the data that they have given us as far as the performance of that asset over the last 12, 24, 36 months. We require them to update that on a quarterly basis.
Okay.
We do diligence on the asset operator themselves as far as their track records, any outstanding lawsuits, any failed properties, any default,
Okay.
That type of stuff.
Yes.
And we also reserve the right, if the asset owner is the manager or they use a third party property manager, and there are some bad boy scenarios, they're not managing the property according to the operating agreements, they're just mismanaging the asset, we have the right to remove them as the manager to protect the investors. We set up our token platform as a 3-token scenario. The security token represents the LP interest, the ownership in the asset.
Okay.
There's an identity token, which basically confirms the accreditation and the KYC of the investor. And then there's the governance token. And the governance token is basically who controls the asset, who's the manager, who's running the show. And so if there is a scenario where there's a bad boy, there's mismanagement, we have the right to pull that governance token and hire a new property manager to get that property back on track.
I see. Interesting. How many properties do you currently work with?
So up until this point, we've got close to a dozen that we have gone full cycle with. Over the next 2 quarters, we've got about 100 million in due diligence. Properties ranging from 10 million upwards to 75 or 80 million that we're going through the process of doing proper due diligence on these assets. And then our goal this year is to have $1 billion on the platform by year end, which would equate to somewhere around 300 to 350 million in equity.
Okay, very nice.
And I think those numbers are going to move exponentially. The other, the request that I get all the time is from developers because, they're looking for other capital sources and ways that they can, bring new dollars to their development deals. And they're always asking me, can we tokenize a development deal? And the answer is yes, but it's just not today. The market is not ready for it. We're doing core and core plus assets. We're doing fully stabilized assets that have cash flow. Our thoughts are that investors and advisors will be more comfortable with those in the beginning, But then there's going to be an appetite for more opportunistic types of properties where instead of getting a 6% dividend and a 4% growth, maybe they can do IRRs in the 15, 20, 30% range. And that's the only way to get that is through development. So my guess is we'll probably have the opportunity to start tokenizing development deals maybe 18, 24 months, maybe a little sooner than that. We've had a couple that we've come close on, but it's just the market needs to mature, and I think we'll be there pretty quickly.
Okay. And well, what about farmland? Is that part of this equation, potentially at least?
We have not done any farmland yet, but I think if there's a farmland with a working business and there's an income stream, I think certainly we could be open to it. It's just we don't have any absolutes on any type of property or any type of asset. We look at each deal as an individual real estate deal and the merits of those deals. So whereas we may turn down an office building in downtown Detroit right now, we may find an office building somewhere else in the country maybe worthwhile. But really, what we want to do is bring high quality assets. We want the experience for the RIA in the investor to be able to come onto the platform and have choice of what types of properties they want to invest in, have choice of the risk profile of those properties and geographic location. So if you've got someone that really likes Southeast multifamily, they can build a portfolio that way versus, being able to do that on their own is impossible unless you've got hundreds of thousands to millions of dollars to do that. So our platform gives them access, but they really can design it the way that they want it. And that's the key component, is giving them access and control of where they want to invest.
So again, it sounds like the platform, the AKRU platform, the way it's currently conceived and operating, really is geared toward the sophisticated professional investor who knows they want to be in real estate and knows that they want to have, let's say, wrong term, but you'll know where I'm going with this, single stock exposure. They know exactly what they want, and they see AKRU as a platform to basically facilitate access to that investment property. You help with the diligence, you help identify it.
Yeah, I would agree to a certain extent on that. What I think what we realize, whether it be an individual investor or a wealth manager, not everyone has a high level of experience investing in real estate. Okay. So, in order to invest in real estate, you need to do due diligence on the property. You need to look at, the data on the property, because real estate valuation is 100% about the data. And a lot of people don't know how to look at that. So one of the areas that we will also help, whether it be an RIA or investors, is we can build model portfolios where we basically ask them what they're looking for. They give us their profile of what they're interested in, and we can help them build their portfolio for them. And they'll always have access to the data. But if they're not comfortable making that decision on their own, then they can buy into a model portfolio as opposed to having to pick each individual share by itself.
Okay. And Will, are there any institutions using this technology now?
Yeah. I mean, as I mentioned, Franklin Templeton has done it on the fund side for U.S. government securities. They own Clarion. Clarion is a large real estate asset owner. We've had conversations with Apollo that are starting to move forward. The CEO of BlackRock has already made the statement that they're moving forward, and they're very, very large real estate asset owner operators, everyone knows. So yeah, it's whether they've launched it publicly or not, the technology is being built, or they're partnering with technology partners like us. So we've had a lot of those conversations. I've talked to several very large sponsors, with $15 billion portfolios that say, listen, we want to move forward, help us do that. So I think the environment, 6-12 months down the road, you're going to see major players that have already started doing this, announcing it. And it's really going to move the market along nicely.
Okay. And what would you say, given your experience to date, your experience and AKRU's experience in this business, what do you see as the downside to this approach, if any?
As far as the actual tokenization itself, there's really no downside. There's a benefit to the investors because they have liquidity. There's a benefit to the asset owners. I think it's education and adoption and how long it's going to take folks to get comfortable with it. Right now, we don't have a ton of volume on the trading side. People ask us what our volume is, and that's not really how we measure it, because when people are buying real estate tokens, real estate is a buy and hold asset. So
Sure.
the tokens that we, first tokenized a couple of years ago, people are still holding on to them. They're not trading them like they would, a stock or any other arbitrage type of investment. So I think that the downside is just how long it's going to take for adoption. But we've got a lot of early adopters. We've got a lot of RIAs that have come onto the platform, that they've started to make allocations already. We're starting to see a lot of big players in the marketplace move forward. So there's only benefits to the real estate market when it comes to using blockchain and the tokenization side. It's just getting everyone on board and up to speed and standardizing some of the data and some of the knowledge. And that's just a matter of time.
So if I understand you correctly, really what you're saying is the downside potentially is investment risk, right? That you make an investment in a property that doesn't turn out so well.
And that's real estate, right?
That's real estate, exactly.
That's real estate. So the investment profile of real estate does not change. We have not eliminated downside risk. But you have a major tenant move out, or you have a credit swing that's going right now, or you had COVID for office. None of those risks get eliminated because you're investing in real estate. But over the long term, real estate has always been the largest investment asset class in the world. People invest in real estate because they want to gain wealth. And so it's the same profile, but you may have short-term swings in certain real estate markets that can create some losses. But in the long term, real estate has always been, a phenomenal investment.
Absolutely. And if I may just ask a follow-up on this, earlier we were using, and I think you were using the exchange metaphor, right? As if to draw a parallel with the public markets. In the public markets, we have the same type of risk, right? You have investment risk, but you also have, let's say, settlement risk in the public markets. Even though it's minuscule, it still exists. Are there any such risks in this approach to investing? Is there anything on the settlement side that might be problematic? The exchange of money for shares, for example.
Yeah, I mean, when a transaction is consummated, the transaction is done in seconds. So it's not like a T+1 plus
right, and that's the advantage of the blockchain.
Correct. And so these transactions are done instantaneously.
Yes.
I can say the real risk for coming from our platform side is if you really have to get out. There's not a guarantee that you're going to have someone that is willing to pay the price that you want on the buy side. So you may have to discount your price, or you may have to wait a little longer. But that's how real estate works. It's a conversation and a negotiation. So we're not taking that out of the game either. If you really need to sell, you can discount your shares like anything else, and you'll have a buyer for it. Much like if you own a multifamily property and you really need to get out of it, you drop the price 5 or 10% and you'll have buyers. That's our platform is the exact same way. So you still don't lose the real estate side of the transaction when it comes to how real estate is traded. That doesn't get
but to go back to something you said earlier, you said how a lot of this has to do with education, and that's your job, right? So one way that you can let's say mitigate this risk going forward is by getting more sophisticated professional investors to participate on this platform. And in doing so, one would think, at least in theory, that it will come along with greater liquidity. So, right, you're not going to find yourself in situations where, let's say, everyone wants to run out of the door at the same time. There's going to be folks on the other side that may want to get in the door as some want to get out of the door. And that's the function, again, using the term in the generic sense that an exchange plays, right? An exchange and a clearinghouse. That's really what AKRU is attempting to replicate, basically take that model from the public markets and adapt it to the private real estate market, correct?
Yep, that's exactly right. Yeah.
Okay. Where do you see this technology? I know we talked about I think you mentioned a year, 18 months out, but let's say 2 to 5 years out. Given the fact, or given what you also said that I guess a year ago when you were out moving about, you found that the concept was a bit alien to people. It was tough for people to grasp what it was you were, what it was AKRU was doing. So how do you see this 2 to 5 years out?
I really see the use of blockchain to become a standard practice in all real estate transactions. Whether they're tokenizing the assets or they're not, the connecting the data to blockchain is going to be a standardized practice. And the ability to invest in these types of this asset class, whether it be through an individual asset or a fund of tokens, is going to be the standard as far as how these assets are coming out. If you look at the old school Reg D offerings, that is just an old chassis with a lot of expenses and no liquidity. And I think with adoption and education, these types of programs are going to be the way people are investing in real estate. And the blockchain is really, all asset owners will be utilizing it to make their data management more efficient.
And one other question here, brokerage fees. Are there any brokerage fees here?
Yeah.
How does that work? What are the economics? I mean,
so the way AKRU makes money. So we charge a flat fee to the asset owner when they list on the platform. So what's interesting is that when you get into an initial offering where an RIA is making allocations for their investors, or an investor gets into initial offering, those initial offering, the price of the token is always $1,000. There are no fees on that initial offering. In the secondary market, there's a 1% fee in the buy side, 1% fee in the sell side. And for a distribution, there's a 1% fee to the asset owner, there's a 1% fee to the token holder. But those are really the only fees that are involved. But for an investor or an RIA, the best time to get into these offerings is in the initial offering, because the fees on that transaction are paid by the asset owner, not by the investor, not by the advisor. So they're getting 100 cents on the dollar in the ground in that transaction.
Interesting. Well, Will, our time is about up, and I just want to give you an opportunity to maybe make some closing comments. I mean, this is a no question about it. It's a leading edge type of idea, and it's more than just an idea. You're actually in business. You're up and running. Yep. And I have to say that the roundtable over the last, let's say, 2 years or so, we've had a number of conversations, a number of folks like you on board that are in a real way attempting to apply this blockchain technology to various aspects of the investment world. And I'd just be curious to hear you sort of sum up where you see AKRU going, where you see this market going, and the demand for services like this.
Yeah, like I said, I think blockchain is going to revolutionize the real estate marketplace. I see adoption within the next 5 years to be across the board. For us personally, we work two sides of the machine. We work with asset owners to help them create liquidity. We work with RIAs to help them better allocate to real estate. Where I see this industry going is, past the moon, outside of this universe, as far as where the opportunity is. The heavy lifting is, we're a disruptor in a marketplace, and part of the burden of a disruptor is you have to educate. Not only are you educating your potential clients, but you're potentially educating some of your potential competition. And we accept that burden. But if you're looking to allocate to real estate, you're a financial advisor, strongly recommend, hopping on the platform. It doesn't cost you anything to open up on the RIA portal. You can start to look at some of the deals that are coming on board. You can dip your toe. There's not a huge commitment here. And if you're working with asset owners, again, we don't charge a dime to educate. We don't charge a dime to do the initial due diligence. We're working both sides of the machine, and eventually, we'll have a very nice, efficient marketplace going forward. So I think for RIAs, it's a great way to add value to your clients, and for asset owners, it's a great way to access equity.
And again, just one point just popped up in my brain. In the event that something were to happen to AKRU, and since you're using the blockchain, right, all these transactions and relationships are evidenced and facilitated through the use of the blockchain. I assume a smart contract would be affected, so that if something were to happen to AKRU, the real estate investors would be protected.
Yeah, if AKRU were to go away, they still have record of ownership in that asset. And that the beauty of the blockchain is that never goes away. So it's not like they have a piece of paper that they lost in an envelope in the drawer 10 years ago and they can't find it. By using the blockchain, their ownership is protected and guaranteed.
It's memorialized, it's evidenced on the blockchain.
Exactly.
Very interesting. Well, Will Powers of AKRU, I want to thank you on behalf of the roundtable for sharing your insights and experience in the world of real estate investing. I mean, as we heard a moment ago, this is a very exciting new business, and it does sound like there are tremendous opportunities going forward. So I want to thank you. I also want to thank our audience and encourage our audience to check our website for information about upcoming events, especially the next event that we're having on June 1st with William Silber, former chaired professor of the at the Stern School of Business, New York University, who will be discussing his recent book, The Power of Nothing to Lose: The Hail Mary Effects in Politics, War, and Business. So I hope you'll all join us for that. And again, Will, I want to say thank you. I think this was very interesting.